Welcome to U.S. Tax Unpacked, where we make U.S. taxes simple, clear, and fact-checked. If you've earned or invested in crypto, you've probably heard that the IRS is updating its reporting rules. Don't worry, this isn't a crackdown, it's a cleanup. Today we'll look at exactly what the IRS is changing for 2026 and how you can stay compliant without stress. Hit like and subscribe so you never miss an update that could save you money and keep you out of trouble. The IRS has been working on crypto tax rules for over 3 years, ever since Congress passed the Infrastructure Investment and Jobs Act in 2021. That law required brokers, including exchanges, wallet providers, and trading apps, to report sales of digital assets just like stockbrokers report share sales. After several delays, the IRS finalized those rules in 2025 and introduced Form 1099-DA. Starting January 1st, 2025, any broker who facilitates digital asset transactions must report gross proceeds to the IRS and to customers. This includes crypto, stablecoins, and NFTs. Basically, anything recorded on a blockchain with monetary value. The goal is simple. Treat crypto like any other investment so that everyone plays by the same reporting rules, and tax compliance becomes easier for honest users. In its 2025 update, the IRS tightened the definition of digital asset. It now includes cryptocurrency, stablecoins tied to the US dollar, and non-fungible tokens, or NFTs. In simple terms, if it lives on a blockchain and you can transfer it for money or value, it counts. That means even some gaming tokens and utility coins are taxable if they can be sold or traded outside the platform. Transactions subject to reporting include sales, trades between different coins, crypto to fiat exchanges, and payments made in tokens for goods or services. Yes, if you're a freelancer or creator accepting crypto payments, those are taxable income. The IRS also clarified that foreign wallets and international platforms are not exempt if they serve U.S. clients. The aim is global reporting consistency, no more offshore wallet loopholes. 1099-DA is the IRS's new digital asset equivalent of a stockbroker's 1099-B. Starting January 1st, 2025, brokers must report the gross proceeds from every digital asset sale they facilitate. That includes centralized exchanges, some DeFi platforms that act as intermediaries, and even certain wallet providers. Each Form 1099-DA will list transaction dates, asset types, wallet addresses, and USD values at time of sale. For large transactions, those over $10,000, brokers must also report to the IRS under anti-money laundering rules, though the IRS has granted temporary relief from backup withholding through 2026 under Notice 2025-33. Taxpayers will start receiving their first 1099-DA forms in early 2026, covering 2025 transactions. So if you sold, swapped, or spent crypto in 2025, expect a form just like you would for stocks, and check that your records match before filing. Let's get clear on who these rules actually affect. For everyday traders and investors, nothing dramatic changes about how profits are taxed. You still report capital gains when you sell or swap tokens, just like stocks. What does change is that the IRS will now receive official reports from brokers, so your 1099-DA and your return need to match. For creators, influencers, and freelancers who get paid in crypto, those payments are ordinary income, taxed just like cash. If you're a business accepting tokens for services or DeFi rewards, you'll need better records of fair market value at the time received. The silver lining is that these rules reduce gray areas and protect compliant users from future audits or random letters. The IRS isn't trying to punish crypto enthusiasts. It's trying to bring clarity and fairness to a market that was previously a free-for-all. Here's how this plays out in real life. Imagine a content creator who receives $5,000 worth of crypto tips from supporters through a platform like Patreon or Twitch. That $5,000 is taxable as ordinary income on the day it's received, valued in US dollars using the exchange rate at that time. Later, if they sell those coins for more, the gain is reported as a capital gain. Now take a trader who sells Ethereum for a profit after holding it for 15 months. That's a long-term capital gain taxed at 0%, 15%, or 20% depending on income. If the same trade happened after 6 months, it would be a short-term gain taxed as ordinary income. Both the creator and the trader will receive a Form 1999-DA from their platform showing these transactions, making reporting much simpler. No more guesswork or spreadsheet chaos. Crypto profits are taxed according to how long you hold them, just like stocks or mutual funds. If you hold a digital asset for more than 12 months before selling, you qualify for the lower long-term capital gains rates of 0%, 15%, or 20% based on your income bracket. Sell within a year, and it's short-term, taxed as ordinary income, potentially as high as 37%. The rules apply to all taxable events: selling for cash, swapping one token for another, or spending crypto on goods and services. If you sell at a loss, you can use those losses to offset other capital gains and deduct up to $3,000 against ordinary income each year. This is why tracking purchase dates and values is crucial. The IRS is not changing the rates. It's just making sure crypto fits into the same tax framework as everything else. The IRS has made one thing very clear: record keeping is your responsibility. Even though brokers will now file Forms 1099-DA, you still must keep your own documentation. For every transaction, note the date, what you bought or sold, the USD value at that moment, and why the transaction occurred: sale, swap, payment, or gift. Most reputable exchanges offer downloadable transaction reports that can be stored digitally or imported into tax software. You can also maintain a simple spreadsheet. The IRS accepts electronic records as proof of basis in gain calculations. While the law requires taxpayers to keep records for at least 3 years, the IRS recommends keeping crypto-related records for up to 6 years due to the complexity of digital asset audits. Good records mean fewer headaches and complete confidence when you file next April. Let's be real. When the IRS talks about enforcement, people get nervous. But this time, the focus isn't punishment, it's accuracy. Once 1099-DA forms start rolling out, the IRS will use its usual data matching software to flag inconsistencies between what brokers report and what you file on your return. If there's a discrepancy, you may receive an automatic CP 2000 notice asking for clarification, not a penalty. Under Notice 2025-33, brokers also get relief from backup withholding through 2026 while systems stabilize. So users won't see automatic tax withholding from crypto sales just yet. Civil penalties kick in only when someone willfully fails to report income or ignores IRS requests for information. For the average honest taxpayer, this is about clarity, not crackdowns. Here's how you can get ahead of the new rules. First, download all your exchange and wallet data for 2025 now. Don't wait until tax time when platforms may purge old records. Reconcile each transaction so your totals match what you expect to see on Form 1999-DA. Second, track your cost basis, what you originally paid for each asset, and the date you acquired it. That will determine whether your gain is short or long-term. Third, consider using tax software or a CPA experienced in digital assets. Crypto reporting is becoming mainstream, and specialized tools can import data directly from wallets and exchanges. Finally, stay organized throughout the year instead of scrambling in April. It will make filing your 2026 return a breeze. So what does all this really mean? The IRS isn't trying to end crypto. It's bringing it into the same reporting system that governs stocks, mutual funds, and bonds. That means less confusion, fewer surprises, and a level playing field for everyone. If you've been keeping clean records and reporting honestly, these changes actually help you. They make your compliance easier and reduce the risk of audit letters based on incomplete information. The best part is that technology is catching up too. Wallets and tax apps are now automating what used to take hours of manual tracking. By 2026, crypto reporting will be as routine as filing a 1099 for a stock sale. And that's a sign of a maturing market, not a restricted one. Compliance isn't a burden, it's a badge of professionalism in the digital economy. Thanks for watching U.S. Tax Unpacked, where we make U.S. taxes simple, clear, and fact-checked. If this video helped you understand the new crypto reporting rules, please give it a thumbs up and share it with someone who could use some clarity. Subscribe to our channel for weekly updates that help you navigate tax changes without the panic. Remember, the goal isn't to fear the IRS, it's to stay ahead of it with knowledge and good records.